If you are holding QYLD for that sweet 11% dividend yield or other covered call ETF, you should watch this video because a massive change in the ETF world just happened, and it's making old income funds look kind of terrible. Older funds like QYLD suffer from net asset value decay because they sell options on 100% of their holdings right at the current price. They take all the losses when tech drops, but get none of the recovery when tech bounces back. Your principal slowly bleeds out. GPIQ is an actively managed exchange-traded fund from Goldman Sachs that holds the tech-focused NASDAQ 100 index and sells a portion of call options against it, allowing investors to capture both high monthly income and partial stock growth. GPIQ's out-of-the-money strategy acts as a shield against the net asset value trap. Although GPIQ is a relatively new fund, but rapidly growing fund that has quickly made an impact on the covered call space. The market view is exceptionally strong, with the fund being heralded as the king of the covered call ETFs. Its latest AUM is $4.29 billion, offering a compelling blend of capital appreciation and high yield, which the document notes is a massive change making older income funds look kind of terrible. Now that you know what GPIQ is, let's discuss the differences between GPIQ, QQQ, and QYLD. QQQ is pure index tracking. It buys and holds the NASDAQ 100. There are no options overlays. You get 100% of the index's upside, 100% of its downside, and a minimal dividend yield, approximately 0.6%. QYLD, full upside cap, high income. QYLD buys the NASDAQ 100 and writes, sells at the money call options on 100% of the portfolio. This generates a massive monthly distribution, approximately 11 to 12%, but it completely gives up the index's capital appreciation. GPIQ, partial upside capture. GPIQ uses an actively managed dynamic options strategy. Instead of capping all growth like QYLD, it writes out of the money call options on only a portion, typically 25 to 50% of the portfolio. This allows it to generate high monthly income, approximately 9.3%, while still participating in some of the index's upward moves. This can be reflected from the price growth in the last 2 years. In different market conditions, these three ETFs behave differently. 1. When market is in a bull market, QQQ is the clear winner. When tech is ripping upward, QQQ captures the full velocity of the market. GPIQ takes second place. Thanks to its out-of-the-money, partial right approach, it captures a meaningful portion of the rally while collecting premium. Over a 1-year trailing period, it has delivered strong double-digit total returns, often outperforming QYLD by a wide margin. QYLD lags heavily. Because its options are sold at the money, its equity value gets called away during sharp rallies. You get your steady monthly dividend, but your principal flatlines or even decays relative to the surging index. 2. In a flat market, QYLD and GPIQ shine. When tech moves sideways, the premiums collected from selling options become pure profit. QYLD often edges out the others here because it sells the most aggressive options at the money, extracting the maximum possible premium to pass on to you as income. QQQ stagnates since there is no capital appreciation and negligible dividend income. 3. In a market correction or bear market, all three will lose value, but the options income buffers the fall slightly. GPIQ and QYLD offer a small defensive cushion. The high monthly premiums act as a partial shock absorber against falling stock prices. QQQ will experience the sharpest, rawest drawdowns because it lacks any income mechanism to offset capital losses. However, historically, QQQ recovers its losses much faster during the subsequent rebound than a fully capped fund like QYLD. Who is GPIQ for and what should avoid it? The GPIQ ETF is primarily designed for income-oriented investors, such as those nearing or in retirement who need a high monthly cash flow but still want to participate in the growth of large-cap tech companies without completely capping their upside potential. Long-term accumulators. If you are in your peak earning years and building wealth for a distant retirement, you should avoid it. By capping your upside, GPIQ will almost certainly underperform a pure index fund like QQQ over the long haul. Tax-sensitive investors in non-registered accounts. Because GPIQ derives its yield from options premiums, those high monthly distributions are typically taxed as regular income or capital gains rather than eligible dividends. If you hold this in a regular taxable account, it can create a heavy, inefficient tax drag. Defensive investors seeking downside protection. While the options premiums provide a tiny cushion, GPIQ is still holding a highly volatile, tech-heavy portfolio. If the Nasdaq crashes 30%, GPIQ is going to drop right along with it. It is not a safe haven or low-risk asset. Please subscribe if you found this information helpful. It takes just a moment and helps me continue creating in-depth financial content. My proposed strategy for Nasdaq 100 exposure. I would tailor the investment strategy for Nasdaq 100 exposure based on your time horizon and income needs, utilizing the unique characteristics of QQQ, GPIQ, and QYLD. Under age 35, the accumulator, investors who are young and focused on wealth building for a distant retirement should primarily buy QQQ. This ensures full exposure to the market's upward momentum, maximizing long-term capital growth, as capped upside funds like GPIQ and QYLD will almost certainly underperform a pure index fund over the long haul. Ages 35 to 55, balanced growth and income. For investors in their mid-career who still seek growth but desire some portfolio stability or income, a balanced approach is recommended. This can involve allocating 50% to QQQ for continued capital appreciation and 50% to GPIQ to generate monthly income through partial call writing while retaining some upside potential. The monthly distribution from GPIQ offers a valuable defensive cushion. Ages 55 and over, income prioritizer. For those nearing or in retirement whose primary goal is high monthly cash flow and downside buffer, the strategy should prioritize income-generating covered call funds. This portfolio would be weighted 50% toward GPIQ to capture some potential upward movement and 50% toward QYLD to maximize immediate monthly distribution. This approach optimizes for cash flow while providing a small measure of growth potential and a buffer against falling stock prices. As you are getting older, you can gradually put more weights on QYLD to maximize cash flow. Tax. For any investment, we have to take tax into consideration. The distributions from GPIQ are generally taxed as ordinary income or short-term capital gains, which are typically taxed at a higher rate than qualified dividends or long-term capital gains, which you would receive from a pure equity fund like QQQ. For international investors, such as Canadian residents, holding a U.S.-listed asset like GPIQ introduces currency and cross-border tax at 15% in a non-RRSP account. To minimize the tax drag from a high-yield fund like GPIQ, it's generally better to hold it in a registered retirement accounts like RRSP. Disclaimer: this content is for educational purposes only and is not financial advice. Always consult a qualified professional and conduct your own research before making investment decisions. Goldman Sachs didn't invent this partial right strategy. They are challenging JP Morgan's GPIQ ETF. But Goldman's aggressive pricing and active management are proving that they are ready to fight for the crown. The era of buying 100% covered call ETFs like QYLD for pure yield might be over. Funds like GPIQ have rewritten the rules by offering high monthly distributions without completely killing your capital growth. Assess your age, check your tax accounts, and let me know your thoughts in the comments.